When you buy a call option, your risk is capped. If it goes in the money, you make a clear profit. However, limited risk and a positive payout do not make a trade automatically permissible. The truth is, the financial outcome of a trade, the profit or the loss, has zero bearing on whether it complies with Shariah principles. Compliance is determined by the contract structure. We must look at the legal reality of what you are actually buying. On the left, a standard asset purchase. On the right, a conventional call option. We need to decode their underlying mechanics. This creates a clear trade-off. You are choosing between the massive capital leverage of conventional derivatives and the structural validity of a permissible spot purchase. Avoiding impermissible trades requires you to ignore market hype regarding leverage and audit the legal reality of the contract itself. Let's establish a benchmark using a standard spot market transaction. Suppose you buy 100 kilograms of wheat for 5,000 rupees. This diagram shows the mechanics. It's a direct exchange. You hand over currency and receive an identifiable physical asset. Applying the Shariah checklist here, the transaction is clear. The asset is permissible, you have established ownership, and you have taken actual possession. This valid structure requires full upfront capital. By paying the full 5,000 rupees, you eliminate the possibility of using high leverage. This trade is compliant because its foundational structure is a direct exchange of owned assets. This is the standard by which all other trades must be judged. Now let's look at trade B. Suppose the Nifty is at 25,000 and you pay a 100 rupee premium for a call option. Look closely at that 100 rupees. What physical or digital asset did you actually purchase with that premium? The trader never purchased the underlying asset. This flow diagram maps out how the premium only buys a contractual right. You're paying to enter a future transaction. The structural danger arises when this abstract right is traded as an independent asset. Shariah strictly prohibits trading abstract rights as tangible property. Conventional F&O provides massive market leverage for minimal capital, but it does so through an inherently invalid structure. Because a call option trades an abstract right rather than an owned asset, the foundation of the trade is impermissible. Any potential profit is therefore spiritually invalid. Suppose the market moves in your direction and the Nifty index rises to 25,500. Financially, the contract now has 500 points of intrinsic value, a clear economic gain. However, temporary economic value does not transform the underlying contract into a valid sale of an owned asset. Many mistake cash settlement for a compliant payout. Here's how the exchange concludes the contract. Instead of delivering actual shares, the exchange simply pays you the 500-point difference. Cash settlement is merely a logistical method. It cannot fix the contract's impermissible origin. Intrinsic value and cash settlement are financial mechanisms that distract from the fact that the original contract was structurally flawed from day one. We see the same structural issues in conventional futures contracts. This timeline shows how a future works. You agree today to exchange an asset and payment at a deferred future date. Checking for ownership and possession, we find neither exists today. The contract's fatal flaw is mandating the sale of something neither party possesses. Futures are prohibited because they violate the structural rule against selling unowned property. The common belief that they are forbidden due to unlimited risk is a secondary issue. To navigate these markets, you need a universal rule for evaluating any financial instrument. The focus must remain on the mechanics of the deal rather than the names of the assets. You must look past the evaluation methods that focus solely on profit margins, risk limits, or how a payout is settled. Memorize this sequence: asset, ownership, possession, contract, and settlement. This is the logic required to audit any trade. Conventional F&O offers speed and high leverage, but utilizing these tools requires a full departure from structural Shariah compliance. Strict compliance is a path that demands accepting the lower leverage inherent in the spot market. Structural integrity is the ultimate foundation of permissible wealth building. It ensures your capital is grounded in a legal reality, regardless of market volatility. Do not let market jargon or the illusion of intrinsic value blur your principles. Audit the legal reality of every contract before you commit your capital.